Good afternoon, everyone, and thank you for joining us today. My name is Christina Rose, Director of Strategic Alliances at Foundation Source, and I will be facilitating today's webinar discussing philanthropy and transition, navigating the shifting tax landscape. I am pleased to be joined by Jeff Haskell, Foundation Source's Chief Legal Officer, who will be moderating today's conversation. He will be joined by our esteemed panelists, Jane Searing, Managing Director at Deloitte Tax LLP, Global Center for Excellence in Philanthropy, and Brad Bedingfield, Partner at Hemenway Barnes, LLP. I will introduce them in a few moments, but first wanted to touch base on a few points. For anyone not familiar with our firm, Foundation Source is the nation's largest provider of management solutions for private foundations. We empower people and companies through our suite of services, including administrative support, active compliance monitoring, tax and legal expertise, online foundation management tools, and philanthropic advisory services. We work in concert with financial advisors, attorneys and CPAs, consultants and family offices, individuals, families, and corporations to bring philanthropic visions to life. As we celebrate our 20th year of service, Foundation Source supports nearly 2,000 foundation clients of all sizes who together have granted more than $7 billion to charity. Now, a quick word about Wi-Fi and phone connections. Probably like most of you, we are working remotely. We don't anticipate any technical issues during the broadcast, but if one of us loses connection, just know that we will quickly get it resolved and resume the webinar. And if you experience problems, you can try exiting and then rejoining the broadcast. Also, audio may be better via phone than on your computer. It will also reduce some strain on your Wi-Fi connection. Questions can be submitted at any time via the GoToWebinar dashboard on your screen. We will be leaving some time at the end of today's presentation to address your questions. And if we don't have time to answer all of your questions, please know that we will follow up with you directly after the webinar. Now, in the next couple of days, we will be sending a link to the recording of the webinar, so everyone who signed up will receive one. And now it is my pleasure to introduce Jeff, Jane, and Brad. Chief Legal Officer Jeffrey Haskell has been with Foundation Source since its founding in 2000. Together with a team of attorneys, accountants, and support professionals, he provides tax reporting services and guidance on legal and tax issues to Foundation Source clients and their advisors. Jane Searing is Managing Director at Deloitte Tax LLP, Global Center for Excellence in Philanthropy. She specializes in tax-exempt organizations, private foundations, and philanthropic planning. Jane leads the Global Center for Excellence in Philanthropy, which is focused on delivering high-value compliance and advisory services, assisting clients with their complex philanthropic strategies and implementing innovative tools. Brad Bettingfield is a partner at Hemenway Barnes and chair of the law firm's nonprofit group. He has 15 years of experience in private practice and previously worked in the IRS's national office as a tax law specialist with the Exempt Organizations Division. In addition to assisting private foundations and public charities, Brad advises high net worth clients on legacy planning, and he counsels families on structured charitable giving, estate planning, and lifetime gifting strategies. And with that, Jeff, I turn it over to you.
Thank you, Christine. Well, there are three proposals, including two pieces of legislation that we'll be discussing today. The Biden plan, known as the Green Book, the ACE Act, co-sponsored by Senators King and Grassley, and the most recently released proposed legislation coming out of the House Ways and Means Committee, which is really the birthplace of tax legislation in Congress. The purpose of today's program is to have a timely conversation with two leading experts in the charitable sector to help us unpack these proposals from their unique accounting and legal perspectives. We'll also closely look at the impact these proposals may have on private foundations and donor-advised funds, or DAFs. If you hear us say DAF, we'll know what we mean. And we'll be asking Brad and Jane to share their thoughts on how to navigate and prepare for the potential changes. Brad, can you start us off by providing us with an overview of the key elements of the Biden plan and the latest proposed legislation as they may affect donors and private foundations?
Absolutely. Thank you, Jeff, and thank you, everybody, for joining us. It's important to stress from the top that there are a lot of proposals out there, and we're still relatively early in the fall legislative season. A lot's going to change between whatever we think might happen now and whatever's actually going to happen when something is enacted later in the year. However, we do have two good indicators right now as to what may happen with respect to tax changes in the fall as part of the budget reconciliation, as part of pay-fors for the infrastructure bill and other bills. One of those, as you mentioned, Jeff, is Green Book. For those who don't know, the Green Book is the White House's explanation of its budget proposals. And it's not draft legislation, it's just a narrative discussion of what the White House would like to see. But what the Green Book proposes, and this comes out every year, often finds its way into the legislative language. It's something everybody has top of mind when they're drafting legislation. And so there are proposals there that some of which we start to see already, some of which may pop up later once the White House gets more involved in the drafting process. The other indicator, as you mentioned, is something that came out just a couple of days ago. The House Ways and Means Committee put out a proposal that includes not only a summary, but actual tax legislative draft language for tax changes to help pay for the forthcoming infrastructure bill. And that's a very important starting point for these negotiations. Things will change when it goes to the Senate, things will change when they engage with the White House, but it is a starting point, and therefore it bears some focus. So going back to the Green Book, this is a reflection of what the White House wants to happen. Back when President Biden was running for office, he was pushing for increases in the personal income tax rates, in corporate rates. He was also pushing for reinvigoration of the estate tax, which under the previous administrations had been effectively eliminated for most people in the states. The current estate tax exemption amount is $11.7 million per person, double that per couple. And that's set to sunset, meaning it'll be dropped in half in 2025. But for now, that takes a lot of people out of the estate tax net. The Biden plan, when he was running for president, was to drop that back to Obama era levels of $3.5 million exemption. When those proposals crystallized in the Green Book, his actual budget proposals, some of that survived and some of that did not. So the increases in the tax rates are definitely reflected there. The personal income tax rate would go back up to 39.6%. Capital gains, this was a big headliner in the Green Book. For those with income over $1 million, the capital gain rate would be bumped up to the ordinary income tax rate, which is effectively a doubling of that capital gain rate over a certain threshold. Estate tax, however, was not mentioned at all in the Green Book. Instead, a decision was made to focus more on capital gain reform, a sort of Canadian-style inheritance system. In Canada, what happens is capital gain is of course appreciation on property. Here in America, that appreciation continues to appreciate untaxed until you sell the property. And there's an extra benefit, which is that when you die holding appreciated property, you get a step up in cost basis so that your heirs don't have to pay that capital gain ever. In Canada, their version of the estate tax focuses more on capital gain. So death is a realization event. It triggers that capital gain. Lots of gifts and transfers trigger that capital gain. And that's what we see in the Green Book as well to some extent. On death, that step up in cost basis would be eliminated. So that capital gain is going to get taxed sooner or later. And there are more opportunities for it to get taxed. You don't wait until it's sold. If there's a gift of the property, that triggers the capital gains tax. On death, that triggers the capital gains tax. And this is additional to the estate tax, which would stay in place even under the Green Book. In the House Ways and Means proposal that we got on Monday, some of that we see reflected, some of that we don't see reflected. The increase in income tax rates is certainly there, although it's a little bit different. We do see the increase to 39.6% as the highest marginal rate. Capital gains would be increased, highest marginal rate of 25%, so somewhat lower than what the Green Book is pushing for. The corporate rate would increase, not as far as the Green Book, which wanted to kick it up to 28%. Here it'd be 26.5% under the House Ways and Means proposal, and lots of other various changes, especially many focused on cross-border tax situations. But in terms of death taxes, what we see instead of this Canadian-style capital gain realization, loss of step up in cost basis, instead they're talking about changing the estate tax, so that right now that 11.7 million as it is now is set to drop in half in 2025 if nothing else changes in the law. That would be accelerated to the end of this year. So a lot of estate planning would need to be done this year to take advantage of the current high exemption amounts. In addition, the House Ways and Means proposal would make changes to and eliminate a lot of the strategies that estate planners use to limit the eventual estate tax bill. A lot of planning with grantor trusts, which are trusts where the donor is still the income tax owner, but it's out of your estate. A lot of that would be drawn back into your estate, at least going forward. And lots of valuation discounts would be denied. So people who put assets in family limited partnerships, those valuation discounts would be eliminated. Some of those things are things that we've seen in green books in the past, and they've sort of slowly crept their way into the legislative consciousness, and now we see them. Hard to say what's going to happen when it gets to the Senate, but for now, that's our starting point.
Well, Jane, is there anything you'd like to add to Brad's overview?
No, I mean, that's a good overview. I think for private foundations, one of the things that is important is that with this notion of the step up in basis, for people that still control their private foundations, and I think, Brad, the whole thing of assets being pulled back into the state, and you mentioned it with trusts, whether you're a corporation or a trust or private foundation, if it's still controlled by the donor, that can be pulled back into your estate. And if you don't get that step up in assets and the basis of your assets, it could still be taxed at the estate level, but you don't get the step up in basis when it essentially gets flowed back out to the foundation, and you don't get that step up in basis, which we enjoy right now, and that wouldn't necessarily happen anymore if we end up with that change.
Okay, so turning to the ASAC, Jane, can you give us a brief overview of the key issues?
So this is an act that was, as you said, introduced in the Senate by Senators Grassley and King. And why this is important, I think, is that it's sort of a carrot and stick piece of legislation that's aimed at donor advised funds and private foundations, which are two very popular giving vehicles. And when I say it's sort of a carrot and stick, it's that it is a behavior driving piece of legislation. We don't necessarily think it's going to pass in whole cloth. If you look at the websites and the scorekeepers, I think it has less than 1% chance, but what it's driving at is pushing money out of these vehicles rather than, because the criticism is that these giving vehicles, people get a charitable contribution for putting money into them, but then the money doesn't actually flow out into the charitable sector. So it incentivizes accelerating those distributions out of a donor advised fund, which is a fund that is sponsored by a public charity. So whether it is a community foundation or a public charity that is created by a Wall Street, investment house, which that's where a lot of the donor advised funds are, it incentivizes the money actually flowing out. With a private foundation, same thing. It's going to incentivize behaviors that will drive the money out of a private foundation. So thinking about that. So it's going to disincentivize building up of assets in those vehicles and incentivize moving the money out. So what is it about? It's about the timing of the deduction for the donor, reducing the tax rates inside of a private foundation. So if the tax rate is 1.39%, unless it's unrelated business income, but you could drive your tax rate down to 0% in a private foundation if you exhibit certain behaviors. And then also not allowing certain distributions from a private foundation that currently are allowed for that 5% required distribution of income. It's saying, well, you can still do that, but it won't count towards your 5%. So it is about what is incentivized versus disincentivized. And so that's everything in this piece of legislation is about one of those two things. So in summary, we'll go into the details, but that's in a nutshell what it's about.
And we've seen some of these attempts before at social engineering to incentivize foundations to increase their distributions to the charitable sector when they used to be encouraged to try to reach a 1% tax rate instead of the 2% tax rate if they would meet a bar. So this is perhaps an even more intensive version of that engineering. Brett, is there anything you'd like to add to Jane's overview?
Yeah, I'll just say, Jane's right that this particular bill, the ASAC, probably has a low chance of of passage. However, the ACE Act has a lot of different pieces in it. And I think it quite likely that some of those pieces are going to get grabbed by the legislative drafters in the House or in the Senate as the process goes on. Many of the things in there are things that have been promoted in other vehicles and other forums for a number of years and have gained a certain amount of momentum, like not allowing the distributions to DAFs to count towards your minimum required distribution, or certain other changes along those lines. And the general sense that there needs to be some sort of incentive there to move people away from DAFs, or at least get the money out of DAFs, and to move money out of private foundations, I think pertains. And so I think something in this flavor is going to make its way into some piece of legislation, even if it's not the ACE Act per se.
Right.
Right. There's nothing as dangerous as a piece of legislative language that's been drafted up, because it's going to show up somewhere else.
And it's so common in the tax sphere and in the charitable organization sphere for massive tectonic changes to happen as pay-for additions to some other bill that have nothing to do with the main bill that's being passed, but somebody needed a $10 billion pay-for to pay for something else. And here it was sitting on a shelf because somebody drafted it and gave it a CBO score. And now we stick it on there at 3 in the morning.
Right. So even if it's not the entire thing, parts of it may find their way into other things. So bring us back to Jane. Jane, if the act were passed, how do you think that would affect private foundations particularly?
You know, there's a lot of things that could impact. Let's just say that this whole piece, they decided somebody fell in love with it, and it went through as a whole piece. So if it did, you know, the tax piece is one of them. So there's 2 pieces to the taxes. So you could actually, a foundation, either they limited their life to 25 years. If they agreed to do that right at the onset, they wouldn't have to pay any of that excise tax, the 1.39% excise tax on their net investment income. They could potentially have to pay no excise tax. So they'd have to agree to do that up front. But if they did that, if it was a foundation that was set up, which is sort of unusual, but if they did that, they would have a foundation that had a very limited life, and, you know, that would be, again, unusual, but they could have a 0% excise tax for the life of that foundation. Or if they agreed to do a 7% payout instead of that 5% payout of their net investment income, it's a false. They value their assets at the beginning of every year, and if they pay out 7% of that value of their non-charitable use assets that they value on the first day of every year, if they did that, they wouldn't pay any excise tax on their net investment income. So that would be a big impact. Now, would a foundation change their behavior and drive after that? They might. So that would be, you know, again, behavior change. Would they be willing to do that? The other is qualifying distributions, which is the distributions that satisfy that 5% distribution. If they make qualifying distributions, there's a change in what qualifies. So any distributions to a donor advised fund wouldn't satisfy that. Can they still make them? Sure, but it doesn't count. Same with distributions that pay for administrative expenses of their insiders, which are usually their substantial, specifically they're targeting the substantial contributors and all the family members. So foundations are paying administrative expenses that are for, you know, travel, you know, the meetings for the family to convene. None of those would count towards that 5%. So thinking about those sorts of distributions, they're not going to count anymore. So why is that significant? It means that they're eating into more of the corpus of the foundation, which, you know, that decreases the value of the overall foundation. So one of the distinctions I think we wanted to make today is, can the foundation still make those distributions? Sure, but it doesn't count towards that 5%, or in this case, the 7%, if we're incentivizing to get to our, you know, our tax amount get to 0, but it eats into the corpus. So I don't know. Brad, what do you think? Is there something else that you think would be particularly drive the behavior here?
No, you know, there's always been a debate over the extent to which these incentives about that net investment income tax will change a private foundation's behavior. There are plenty of foundations I worked with, and I know you have too, Jane, where the net investment income tax, it's 1.39% right now. It's not a huge driver. That can amount to a fair bit, but people generally care more about the long-term legacy of the foundation than they do paying that tax. And so if doing that is going to require depletion of corpus over time and threaten that sustainability, they're probably not going to do it. On the other hand, I do know instances back in the not that long ago days where we had a distinction between 2% and a 1% tax rate for that tax. A lot of people would increase their distributions, as you had to keep laddering it up to get the lower 1% rate. So it all depends, but on the whole, I don't think that's going to change a lot of behavior for organizations.
Yeah, about the laddering up comment, again, the way that worked for the audience is that if you met the 1% tax rate, it would continually raise the bar from year to year, making it ever more difficult to qualify for the 1% reduced tax rate by increasing your spend on your charitable distributions. And the thing is, again, just like you had your experience, Brad, mine was we had a number of clients. They didn't really care what it cost them, just for the principle of things. They did not want to pay the tax. This did not jeopardize their existence. They just did not want to pay the tax, and they would constantly jump through hoops to avoid paying taxes and grant more to charity.
Yep.
So, Jane, one of the things that we talked about, and then I was hoping you would spend a moment on, is what about the fact that foundations would no longer be allowed to count their grants and donor-advised funds towards meeting the payout requirement? Do you have any comments for that?
Yeah, in the preparation, Brad and I talked about what's the incidence. How often do we see foundations make grants to donor advised funds, and how do they get used? Because I think that's sort of Congress and Treasury and people talking about, is this an abusive area? How often do we see foundations make grants to donor advised funds, and why are they doing this? And so sort of what I see and what Brad sees, and Brad, I want you to chime in on this. Where I see it is shared grant making. So when two foundations go together to do a particular program, sometimes they'll open up a donor advised fund to do that at say at a community foundation. So rather than one foundation grant to another where they have to do expenditure responsibility and out of corpus distribution, they'll open jointly a donor advised fund to conduct a program together in the community. That's one way. So that would be unfortunate if they couldn't use a donor advised fund for that purpose. Because if they have advisory privileges over the donor advised fund, that wouldn't count towards their 5%. So that would be too bad if they couldn't use it for that purpose. Also, another one is qualified set-asides. You have to get a private letter ruling to do a qualified set-aside. If they can't use it for that anymore, well, now they go back and get a private letter ruling, which is, that's another one. Just to satisfy their 5%, I don't see that a lot. And I think that that's what they're saying. Well, that happens all the time. We have foundations that they only put money into the donor advised fund to make their 5% distribution. I don't see that a lot. So if that's what they're driving at, well, maybe they'll see fewer private foundations use donor advised funds, but that wouldn't be my experience. And then the other one is to avoid tipping small public charities. Again, what's the harm you're trying to stop?
Yeah.
Okay. I don't know, Brad, what's your experience?
Yeah, I mean, the perception here, and as often happens with tax policy, they'll focus on a sort of relatively small universe of abuse and then overcompensate and pass something that affects innocent behavior. The negative perception here is that people are taking their foundation money, putting it in their DAF, and either letting it sit there, and so they've effectively avoided the 5%, or then re-diverting it to their own favorite public charities, perhaps ones that they somewhat control, to avoid the negative effect on the public support test. Not to go down that rabbit hole, but you've got to show, if you're a public charity as opposed to a private foundation, that you get support from the broad public. If you get support from a public charity, that counts as public support. If you get support from your own private foundation, only a little bit of that counts as public support. So you can lose your public charity status. And there are potentially abusive situations whereby people do something indirectly through a DAF that they could not have done directly. And that's what, and the IRS has signaled in past guidance just a few years ago that they don't like that, and they're trying to find ways to change that. However, there are perfectly appropriate uses of the donor advised fund as well. Some of the ones that you mentioned. I work with organizations that use donor advised funds to collectively make distributions from different private foundations or just their own, and then recommend that the donor advised fund make a distribution to a small public charity that is trying to ramp up, where the direct grant could kill them and destroy their public charity status. So I think that this one of the rules that's in the ACE Act is that a grant from a donor advised fund to another public charity no longer counts as 100% public support in most cases. That's one that I think is just going to hurt those public charities who rely on this money, and especially where it's done in perfectly appropriate ways, and those are out there. I do know some clients who have used donor advised fund as a sort of spillover where they haven't gotten their act together or they weren't able to find the right number of grants and the deadline is approaching, and they've put it in a donor advised fund to meet the deadline and then made those payments out relatively quickly. But of all the foundations I work with, I don't know of any who are following that abuse pattern that the IRS perceives as behind this.
I would say, by the way, that this has certainly been on the IRS's radar for some years, whether people are doing it or not, as evidenced by the fact that the annual return of the foundation now asks whether or not the foundation has advisory privileges with respect to a donor advised fund. That was just added a number of years ago. And I also would add that another use that I've seen foundations use donor advised funds has been where they wanted to maintain anonymity. I remember at least one case, the foundation was very concerned about the negative perception because the foundation's annual return is open to public inspection and it contains a schedule of all the grants and purposes that they made over the return year. And they were concerned that some grants that they wanted to make to organizations that were doing charitable things but had a definite bent in a particular political direction would be adversely received. And they knew that if they channeled it through a donor advised fund, the only thing that would show up on the foundation's return would be the grant to the donor advised fund. No one would be able to know that the disbursement ultimately made by the sponsoring organization, by the fund, was attributable to the foundation's advice. I don't know if any of you have seen that as well, but I mean, that's
definitely. I've definitely had foundations who either because they worried about the sensitivity of that being seen, or just because they didn't want the credit coming to them. They wanted it to be sort of an anonymous grant, and that's hard to do from your own foundation directly.
Jane, if the act were passed, how would that affect people looking to fund donor advised funds, and how would donor advised funds themselves be impacted with respect to the concern about having their deductions delayed until and unless the donor advised actually spends out the money that they had used to fund the donor advised funds initially?
That's there's a lot in there. So in this act, as it's been proposed, donor advised funds are broken down into different types of donor advised funds. There's qualified donor advised funds and there's qualified community foundation donor advised funds. But the overall, sort of baseline is that donor advised funds that have a life on them, if you are giving either cash or marketable securities, you would, if they have a limited life on the donor advised fund, you would be able to take the contribution, up front. If you give anything other than cash or marketable securities, that's where it gets more complicated. You wouldn't get your contribution until the asset is sold and the assets are distributed, which is very complicated especially with donor advised funds where they have lots of funds. That donor acknowledgement letter is a key piece. When I looked at this legislation, my feeling was, this is going to be a problem. It's going to be a problem for the donor advised funds. It's going to be a problem for the donor whose responsibility it is to get that donor acknowledgement letter. And it's going to be a problem for Treasury from an enforcement standpoint, because you have to have that donor acknowledgement letter before you file your tax return in the year when the asset is sold. And it's a 30-day window in this legislation. That, I think, is the biggest issue in this legislation, that before this legislation gets passed, somebody needs to take a harder look at that. Seriously, a 30-day window from the date the asset is sold and distributed. That's going to be a nightmare for everybody involved. And, CPAs, it's my nightmare. So it's all about me. Somebody needs to take a look at that, because that's a recipe for disaster, especially for assets that are highly appreciated. If you think about a piece of land or a complex asset, it's going to be hard for everybody. And donor advised funds do have their place in the world. And I just really think that that's something that really needs to be looked at seriously, because really what it means is that people will not be making their charitable contributions of those types of assets. They'll have to do it directly to the charity, because it's going to make it prohibitive, just administratively. I don't know about you, Brad, what you think.
Yeah, no, and obviously the intent of this was to try to force that, where people don't give it to the DAFs and give it to the charity, because they think of the DAFs as sort of keeping it in a sense. The donors put it in their DAF but hasn't let go of it, even though that's not legally what's happening. I work with a lot of public charities, universities, and other organizations that love to receive the benefit of these complex gifts, not cash, not securities, but just aren't equipped to accept these gifts directly. Because of the risks involved, because of the due diligence. And so many of them intentionally at their request, not at the donor's request, use donor advised funds and say, make the gift to this donor advised fund. Their experience, they know how to liquidate it. And then you can recommend a distribution over to us and we just get cash and we don't have to worry about all the complexity. And at least as it's drafted, that would be effectively foreclosed because the tax benefits would be taken away. And so that's going to put a lot more pressure, I think, on some of those public institutions.
Yeah.
So, Jane,
and because you put that, I just say as a closing, once you put that asset in there, you may have one big asset that you want to designate the cash proceeds to multiple charities. Yeah. And so that's the other thing that makes it hard. You may have more than one charity you want to go to, which is the beauty of a donor advised fund. So I think it needs to be reconsidered. But that's,
yeah, and early proposals or discussions of DAF reform focused on payout requirements, 5% payout or something like that to equate with a private foundation. That's the sort of thing that, and that made its way into the ACE Act. The DAFs that are the least affected are these smaller community foundation DAFs that have a 5% payout. If you have those, they more or less work the way that they used to work. And it may be that talking about how something like this might morph into what actually gets passed. It may be that some of those elements are what find their way in there, a payout requirement from DAFs or some additional reporting requirements for the 990 PF, which also made their way into the ACE Act. So I'd look out for that. But as it's drafted, I think it's going to have a lot of unanticipated knock-on effects.
Yeah.
And Jane,
go ahead.
I'm sorry. I was just going to ask you if you could tell us, our audience, how this would be different from the way things are today, just like break out the difference for them.
Yeah, so community foundations they're defined in these in the proposal, and so a community foundations it's about the percentage of assets that are held in a donor advised fund versus outside the donor advised fund, and then the 4-state area that they serve, and I was just at the FAOG, which is the Community Foundations of America, that it's there. I did a little poll of do they serve more than a 4-state area or larger than a 4-state area? And, it would be nice if all 50 states were, 1/50th of the United States. That's not the way we work. And community foundations serve more than a 4-state area, even if they are, huge, like, a Texas foundation or a California. They serve outside of their 4-state area, that's New York is a small state, but the big population. It doesn't work that way. So when they're thinking about defining a community foundation, that's kind of that's not how they define themselves. But so they need to think about what is a community foundation versus, I think they're trying to make a distinction between sponsors of donor advised funds that are sponsored by a wealth advisory firm versus a community foundation. They're trying to find what is the difference between those two. I'm not sure they've kind of nailed that down right. But so anyway, thinking about that, because they're treating them differently and they're trying to, 15 years versus 50 years, but and the 5% payout requirement. I understand they're trying to make a distinction, but I think they need to go back to the drawing board a little bit on that, because that's where they're trying to make a distinction of when would you get a charitable contribution today versus when the assets go out of the donor advised fund. That's the big difference, because right now you put money into anything into a donor advised fund, you get the contribution today as if you gave it to any public charity. What's changing with this legislation is your charitable contribution, you wouldn't get it until either, if it's in the right kind of a donor advised fund, you would get it today if it has a limited life, or you would get it when the assets actually go out. And you have to know what kind of a donor advised fund you gave it to when you get your charitable contribution deduction. And if you give a non-marketable security, non-cash, then you have to get the right kind of donor acknowledgement letter. Life changes for donor advised funds pretty significant.
Yeah, it would definitely have a chilling effect on a lot of gifts. A lot of gifts are year-end gifts. Somebody has a gift of some appreciated, real estate development property that's complex, and they want to give it before the end of the year to take advantage of certain current year tax situations. If they give it to a donor advised fund under the ACE Act, then they're not going to get any deduction in the year of the gift because it's going to be a while before it sells, likely. So any deduction is going to be limited to actual sale proceeds. It's going to be limited perhaps to actual distributions out. And that's just going to make people not give because a lot of the direct charitable institutions aren't going to be equipped to accept some of that property.
So Jane and Brad, I'm just curious, do you think that donor advised funds are equipped to comply with these administrative requirements? And who do you think will really be impacted the most by these changes, the donor advised fund or the donor?
Yeah,
go ahead, Brad.
I think that the donor advised funds already do a very good job of tracking their individual funds and understanding what's happening in each fund. They need to report to the fund advisors. However, the burden increases dramatically with respect to tax acknowledgement letters, being aware of this 30-day window that Jane mentioned. So there's definitely an increased burden, I think, on the donor advised funds. And on the donors and the donors' tax advisors, there's a lot greater risk that you're going to miss something, that you're going to miss your deduction. So I do think there's a significant impact on both sides of that.
Yeah, I think it makes the relationship more contentious potentially. I mean, we've already seen some big litigation that has happened between donor advised funds and their donors. And I think that if this legislation or anything like it passes, I think that the agreement between a donor advised fund and the donor needs to be really looked at hard, and donor advised funds are going to have to be really on top of their game to make sure they don't have a foot fault, because really that's the only recourse a donor is going to have is it's your fault that I didn't get my charitable contribution because you didn't comply with the agreement that you and I had. You didn't give me my donor acknowledgement letter and you cost me a charitable contribution of whatever. And because that's the only recourse they have. There's no penalty from the IRS perspective from a donor, from a DAF sponsor not giving a donor acknowledgement letter. The only recourse is the donor could go back to the DAF sponsor and say, you cost me a charitable contribution deduction.
Yep.
That's the only recourse. So it's really sad. It's a recipe for disaster from that standpoint. But yeah, I think it's going to have a chilling effect, really.
Well, Brad, I know that the House Ways and Means Committee just released that proposal that we talked about a little while ago, a proposal for certain tax changes to raise revenue. How does the committee's proposal differ from the Green Book's?
So, in a number of ways, one of the things that jumps out the most in comparing the two is this focus on the estate tax rather than that capital gain reform. And it may be that the Green Book's proposal to take away the step up in cost basis, which is also something that Biden ran on in his campaign, that together with the estate tax changes is something that the House Ways and Means Committee didn't think that they could get through, but that has fallen away. The trade-off for that is a number of things with respect to estate taxes. The estate tax exemption amount will be dropped effectively at the end of this year in half, subjecting a lot more people to estate taxes. And a lot of common estate tax strategies are going to be effectively eliminated as grantor trust planning is taken away. And so the net effect of that is people are going to have to find other ways to manage and reduce their estate tax bill. With respect to income taxes, there are, as I mentioned, some similarities. The highest marginal rate would go back up to 39.6%. The corporate rate wouldn't go quite as high under the Ways and Means proposal, 26.5 instead of 28 under the Green Book. There is, and I didn't mention this before, under the House Ways and Means proposal, an additional 3% excise tax or additional tax surcharge on top of the regular income tax for income over $5 million.
Let's see, I'm not hearing you, Brad.
I apologize. I think that I hit a key on my keyboard by accident. So Certain tax rate increases are minimized in the Green Book. The corporate tax rate wouldn't go as high, notably, but certain individual tax rates they're going to find themselves higher than they would have under the Green Book because of that 3% surcharge, because of some other changes like an expansion of the net investment income tax.
And Brad, if and when these changes go into effect, and Jane, if you have anything to add, what steps can people take to offset the increase in the income and capital gains tax rates that we're expecting?
Yeah, so in broad strokes, all of these proposals that we've talked about would increase personal income taxes and corporate taxes. There's clearly a recognized need to raise revenue, and that's one of the most straightforward ways to do that. And when your taxes go up, your itemized deductions become more valuable. So one of those is to give more charitable gifts. With an eye towards your adjusted gross income limits, people can give up to, right now it's 100% of their adjusted gross income for cash gifts to public charities. That drops down to 60% in some cases, 50% in some cases, starting next year. But give more to charity to offset that increased taxes. With respect to capital gains rates, one of the things that all of these proposals preserve is the ability to give appreciated assets to charity and avoid that capital gain, because if the charity sells those assets, then the charity doesn't pay capital gain tax on that. That's useful, and partly because otherwise donors would have a much higher capital gain, especially if we don't get the step up in cost basis. So heirs receive highly appreciated property. They can either sell that property, or on death, if we lose if we go with the Green Book's plan, we'd have cap gain triggered immediately. If not, then they'll have highly appreciated property. They can give that to charity and still avoid that capital gain tax. In advance of those changes, if we know that those changes are happening and they're happening on January 1st, and we don't yet know that for certain, then there are things that you can do in advance of that. You can look for ways to trigger that capital gain realization this year when you would pay a lower tax rate than you might next year.
Okay, and Brad or Jane, do you see a role for corporate foundations here?
So I'll jump on that. So corporations are in most circumstances able to deduct up to 10% of their taxable income for gifts to charity. This year, last year, and this year, under some of the COVID relief bills, they're able to deduct up to 25% of their taxable income if those gifts are to public charities, not donor-advised funds and supporting organizations. But corporations often like to give to their own affiliated foundations. They can still do that and make cash gifts to their affiliated foundations. They'll be limited, assuming these are private foundations, as they almost always are, to that 10% level of income, but they'll still be able to effectively do that.
Yeah.
And Jane?
Yeah, and we've done quite a bit of work in this area with helping corporations look at their purpose, their mission, their vision. And when they are engaging with their vendors, with their employees, oftentimes they actually are getting to a place where they are, sometimes they're a private foundation, but they also, some of them are qualifying as public charities.
Yeah.
Because oftentimes what they are giving to they do give substantial assets to their corporate foundations, but oftentimes they are also donating services or facilities, things that don't count for tax purposes. And so they can get to a place where they qualify as a public charity, and they get to a place where they actually they operate much as a private foundation, but they qualify as a public charity, and they can do so much more. And so they're still very much a grant-making organization. They're operating for the public good. And so just thinking about, what's your mission? What are you trying to do in the world? And, they're bringing in their whole community. And so just thinking through what is the corporation's purpose? How does that align with their community, with their foundation, and, who's serving on the board? Really getting to a place of why is the corporation setting up the foundation, and what is the revenue? What are the sources of revenue? And really walking them through that up front. Sometimes they're a private foundation, sometimes they're a public charity. If it is a private foundation, sometimes it's a private foundation with something else standing beside it. So sometimes they have more than one entity even.
And what do you all see as the implication of the elimination of the stepped up in basis? And if it's enacted, what are things that people can do to plan for that eventuality? Either of
I
you.
think definitely thinking about what assets are going to go to, if they have a significant charitable part of their estate plan, going through and really doing an inventory of their estate and what assets they really do plan to leave to charity is a big part of their overall estate plan. What assets are the assets that they're thinking about giving to the foundation? How much of their estate is going to their children, how much is going to, and what's going to be a philanthropic asset, and really thinking through that. And, if they have complex assets, if they have art, if they have property, if they, thinking through what will especially if they have a private foundation, that private foundation is going to be a substantial recipient of assets, especially complex assets like corporations that are operating businesses. Can they qualify for the excess business holding exception? Can they actually have 100% owned and operated business inside that private foundation? If it's a separately managed business, can they qualify? We're seeing that foundations and families looking at that more and more qualifying underneath that.
The new min-zone exception that you're talking about?
Colloquially, yes, that's
so-called.
That is what it's commonly called. Yes, it was passed under the Bipartisan Budget Act, and yes, it is something that is, if you meet the facts, and it can be utilized quite effectively. Yes.
Well, one thing I'll mention, if we do lose the step up in cost basis, one, that's going to force everybody to go back and look at their estate plans again, because right now our estate plans are generally drafted so that certain kinds of income, in particular income from retirement plans, is funneled to charity first, because that's high tax assets that otherwise triggers tax in the estate. Now, if we lose the step up in cost basis, we have to change our estate plans to say, whatever is going to charity in my estate plan, pick and choose the high basis assets, even if it's certain lots of assets, and direct those to, the low basis assets, and direct those to charity first to avoid that capital gain in the estate. If assets are going to family members, pick the higher basis assets that you have to go to those family members. That's not a level of gradation we currently have to do in our estate plans, and it would be really messy, but we'd need to look at that because it could have a huge, huge difference. Secondly, a lot of people in anticipation of the drop in the estate tax exemption amount, which right now is again scheduled to come in 2025, but could come much sooner. A lot of people are considering or making large gifts into trusts to try to use up and freeze that higher exemption amount if they're able to do so. One of the things that keeps people from doing that is the fact that if you hold on to low basis, highly appreciated assets until you die, you get that step up in cost basis. And if you put it into a trust now, you're going to lose that step up in cost basis. And it could end up being somewhat countervailing considerations there. That keeps people from doing it. If we know we're not going to have a step up in cost basis, there's less reason to hold off in making those large gifts into those kinds of family trusts, since you're not giving anything up that you otherwise would have had.
And Brad, how would the Green Book's capital gain provisions affect life income gifts?
That's a really interesting question. Life income gifts to charity, there are a number of flavors of this, but there are two that are primarily used. One of those is so-called charitable remainder trusts. The other are charitable gift annuities, and they're similar, but they're a little bit different. Charitable gift annuities are just like annuities. You purchase an annuity, you give money, and they give you back the right to a yearly payment for the rest of your life, and maybe your spouse's life as well. With a charitable gift annuity, you're giving them more than the value of what you're getting, and that increase is a charitable gift. And it's really popular because it's very simple to administer for the charities. For a charitable remainder trust, you're putting money into an actual separate trust. So you need a trustee, it's got to be managed, and in exchange, you get back an annual payment. Usually in this low interest rate environment, that's a percentage payment of the assets every year. And then when you die or you and somebody else dies, the rest goes to charity. Those are the two primary life income vehicles, charitable remainder trusts, charitable gift annuities. Under the Green Book plan, charitable remainder trusts would be somewhat undercut. Right now, one of the great benefits of charitable remainder trusts is you could give highly appreciated property to that charitable remainder trust. The charitable remainder trust sells that property. Charitable remainder trust is not subject to tax, so it doesn't have to pay any tax. Now that capital gain gets spread out to you as the payments come out every year, but that effectively allows you to defer and spread out that capital gain, over a great period of time. In the Green Book plan, it will no longer work quite as well, because when you give that highly appreciated asset to a charitable remainder trust, part of that will be subject to immediate income tax realization, the gift part that's attributable to the value of the payments you're getting back. However, with charitable gift annuities, unless they change the rules, as the Green Book proposes it, you're still able to do what you can do now, which is give appreciated property and spread out, if it's just an annuity to you or to you and a spouse, spread out that capital gain realization over your lifetime. So that may encourage people to move away from charitable remainder trusts and more toward charitable gift annuities.
And how do you think this will affect people's estate plans, especially in light of the committee's latest tax proposals?
Yeah, I think everybody's going to have to go back and look at their estate plans. A lot more people are going to be subject to estate tax sooner than they might have thought, which may encourage people to look at things like charitable lead trusts, which are vehicles that allow you to give a charitable interest every year for a period of years, and then at the end of that, give your assets estate tax free to your beneficiaries. Those are super powerful in low interest rate environments. And the more people are subject to estate tax, the more they'll have to consider more complex strategies like that. As I mentioned before, they'll need to look at their estate plans to make sure that they allocate the cost basis appropriately if that features into the plan. And it may change incentives in terms of what you do now during your lifetime as well.
I'd like to ask the two of you just one question before we turn it over for Q&A. Which is, how do you think the nonprofit community responded to these proposals?
I think that they, for the most part, are at a place of, we don't really think this is going to happen as a whole, sector. I think that they think that this piece of legislation is not going to pass. For the most part, I think that sponsored donor advised funds think that this act is going nowhere. As a whole piece, and I think private foundations also believe that, but they also think that pieces of it will pass, and then it's a question of what pieces of legislation will it get attached to. And so I think that that's where they have a wary eye to what pieces of legislation might it get attached to, and what will be the pay-fors. So that's, I think, what they're looking at, and trying to have conversation about what are the positives, what are the negatives, and what are the implications. And so, saying these are the pieces that sort of we can live with, these are the pieces we really don't like, and these are the ones that would really be tough to, like the donor acknowledgement one, that's going to be hard for everybody. Probably want to reconsider that. These payout provisions, maybe they would be okay. So I think that's where the conversations are happening. But Brad, what do you think?
No, I think that's right. And from the development perspective, which is often where I'm interacting with the universities, a lot of them are concerned. Ones that rely heavily on charitable remainder trusts, for example, are worried about the impact of that. On the other hand, tax changes are always somewhat terrifying things, and they're wonderful opportunities for public institutions to interact with their donors and educate them and encourage them to make charitable gifts to take advantage of that. And what most of them are telling their donors, and the same thing I'm telling my clients, is it's too early now. We don't know what's going to happen over the next few months. Don't make big transactions now that you weren't otherwise planning to make. However, keep an eye on this and be ready to do something quickly in the last couple of months of the year, because it could make a huge difference, both in terms of estate planning and in terms of charitable giving.
Thank you. Christy?
Yeah, thank you. This has been a great conversation. A lot to unpack, as one commenter said in their question, and that's for sure. So We've received well over 30 questions, which we will not be able to get to today. And just for those who did ask questions, or if you have questions kind of as you digest this afterward, our contact information is on the screen right now. So please don't hesitate to reach out to us. And we will be reaching out to folks who ask those questions we don't get to today. There were a few questions related to the proposed legislation and potential impact on AGI contribution limits. So just throw that out to you, whoever wants to field it, and kind of unpack that a bit.
I'm assuming this has to do with the extension of the CARES Act. So in 2020 and 2021, for donors that give a contribution of cash to a public charity, that you are able to take a contribution of up to 100% of your AGI limit. But excluded from that is a donor advised fund. So that's just an exclusion. You can't, either a new or existing donor advised fund, you're not able to avail yourself of that. Now, if you make a contribution to an operating foundation, which is a subset of types of private foundations, they're a private foundation that essentially operates their own program. So if you're looking at a private foundation, you can ask them, do you qualify as an operating foundation? There are many private foundations that actually do qualify. They would qualify for the 100% AGI limit. Or if you have a private foundation that redistributes 100% of the contributions received during the year, or has excess contributions from 20 or 21 that they can utilize for making what's called an out of corpus distribution. And Jeff Haskell would be happy to help you with that. I can help you as well, but it's an out of corpus election, which means that the foundation redistributes not only its 5%, but 100% of the contributions it receives. It also qualifies for the 100% AGI limit under the CARES Act. So I think that may be what they're asking. I am going out on a limb. Jeff, you think that's what they're asking about? The legislation that's pending has nothing to do with either one of those, though.
Okay.
Yeah, I think that's most likely the case. I mean, people are, they hear us talking about caps and so forth, and I think they're just conflating different things. But I think to the extent that they are thinking of the AGI, they probably are thinking about availing themselves of the conduit election to mimic a public charity, so that you essentially, as a donor, would receive the same type of charitable deduction to the same extent as though you had granted it to a public charity instead of to a private foundation.
Yeah, but if the question is the 100% AGI deduction availability going to continue past the end of this year? It's not under the current proposed legislation. There's nothing in the new legislation that would extend that into 2022.
Yeah, I haven't seen anything in any of the proposed legislation that extends it further.
Okay. And there were related questions kind of about timing, and specifically as we look down toward December 31st, 2021, of any of these proposals for people making contributions into either a donor advised fund or a private foundation this year. Is there any, anything that you see coming through by the end of the year that they need to know?
So with regard to the ACE Act, no. And everything that's in there is prospective. So, and the other thing and Brad, you probably could talk to the other pieces of the legislation. One of the things that I have heard from our people is that some of the provisions in the broader legislation is that they may be actually considering some of those to be retroactive from the date of introduction of the legislation. With the ACE Act, everything is prospective, so it would be, but with the other piece of legislation, it could actually prohibit us doing planning because it would be from the date that it was introduced, which could be complicated for us.
Yeah, there's certainly some elements both in the Green Book proposal and in the Ways and Means proposal that for income tax purposes would be retroactive to some earlier date. The Green Book proposal actually was to make it retroactive back to April with respect to the higher capital gains tax rate. Whether that happens, we'll see. Congress tends to try to do things prospectively, at least in recent history, but they can, especially with income taxes, do things retroactively. I think with respect to charitable gifts, I would not hold off on charitable gifts waiting to see what's going to happen. I think that if tax rates are higher, they're higher, but your charitable gift is still going to have whatever effect you think it's going to have right now. If it's appreciated property, you're still going to avoid that capital gain by giving that. Your AGI limits are going to be, I think, quite, there's nothing to indicate otherwise, are going to be the same in whatever passes as they probably are right now.
Okay, and we have just 30 seconds left, but I'll ask this last question. Hopefully it's a quick one. Do you see trusts or any other charitable estate planning vehicles being grandfathered in if they've already been, created and in existence?
Yeah, so I think this is a reference to the fact that the Ways and Means proposal would take away a lot of our common grantor trust planning. And at least as it's drafted now, existing trusts and existing transactions like sales to defective grantor trusts would be grandfathered in. Whether that's the case in the final legislation, who knows? But there does seem to be at least an effort on Ways and Means right now to make those changes prospective rather than retroactive. So at least at the moment, I'm not concerned that existing planning is going to get upended and grantor trusts get drawn back into folks' estates, but it's going to freeze a lot of the things that estate planners do going forward if that is part of the final bill.
Great, thank you. We're at 3 o'clock. I know there's so much more we could talk about, but I want to thank everyone for joining us today. As I said, in the next few days, you will receive a link to the recording. Brad, Jane, a pleasure having you. Thank you so much for lending your expertise and knowledge for today. Jeff, we're grateful to have your knowledge and expertise in-house at Foundation Source. So just, gratitude for all three of you and really appreciate it. So again, if you have questions, email, give us a call. We'd be happy to have a conversation. And thank you for joining us. I hope the next few months as we lead to the end of the year brings all good tidings and happiness for you and your family. And with that, this concludes our webinar for today. Thank you so much.
Thank you.